Investment managers. I know one guy, he's extremely smart and a very capable investor. I asked him, "What returns do you tell your institutional clients you will earn for them?" He said, 20. I couldn't believe it, because he knows that's impossible. But he said, "Charlie, if I gave them a lower number, they wouldn't give me any money to invest." Charlie believes that the fee-driven investment management business is insane because, as he says, everyone wants to be an investment manager. Raise the maximum amount of money, trade like mad with one another, and then just scrape the fees off the top. Why are they so reckless with our money? Because it is not their money. Let's say I manage a hedge fund, you give me your money to invest, and I use it to help me borrow more money. I then use your money and the borrowed money to place a really big bet. If it works out, you make a ton of money and I make a ton of money in fees. It's a win-win. But if I lose it, you and the bank will be crying, not me. That, for a hedge fund, is a great business model, but it needs to get your money. The second thing it needs to do is keep its hands on your money. It doesn't want you pulling it out and going somewhere else. So how does it do that? There are two hedge fund rules for raising and keeping money. The OST rule, promise investors the sky, because if the hedge fund doesn't promise to make you a lot of money, you won't invest your money. The second rule, any hedge fund that invests your money conservatively won't keep it for very long because the guys down the street who leveraged up threw the dice and one will show much higher returns. That means that in a year or two your greed will motivate you to leave my underperforming conservative fund for the winning, highly leveraged gambler down the street. So there is no economic advantage for hedge funds to be conservative with your money. Yes, they might lose a lot of your money after a few years, but when they do, you will just go end the next high wire and the fund manager who lost your money will just go and start another fund. Don't believe me? Consider this, after the famed Wall Street bond trader John Meriwether crashed long-term capital management in 1998, he started another fund, June Partners, in 1999, which he successfully ran for 8 years, getting assets up to $3 billion. Then the financial crisis of September 2007 cost him 44% of the fund's assets and he had to close it. He then went on to start another fund, JM Advisors, in 2010. The economic reality of the hedge fund business model makes it madness for hedge funds to do anything but leverage up and throw the dice, which is, of course, why they all do it, but despair not, for the folly that these dice rollers get themselves into presents the likes of Charlie with many wonderful investment opportunities.